This tutorial explains the scalability investable attribute at the Darwinia Trading Challenge. We're going to explain why we assess scalability, how we assess it, and also suggest some next steps for doubts you might have after watching it. The reason we assess scalability is that not all returns scale with investor monies. If to date you've just been trading your trader capital and you're thinking of managing investor monies, you'll have to start realizing that as you add more assets under management to your strategy, your average profits will decrease. The reason for this is that as you add assets under management, you will deplete available liquidity. Put it another way, the more investors you have, the bigger the size of your trades will be, and it might become big enough for you to start wiping out the market depth available at any point in time, by which point investors would start getting slipped. In other words, the last euro you're matching at the available market depth will be placed at a much worse price than the first euro, and if you take it far enough, you might get to a point where the last euro is not making additional money. This is when you would have reached your limit to your scalability. That's what makes scalability core to investable trading. So if you're thinking of managing assets in the tens or hundreds of millions range, you'll have to think of trading consistently, but you'll also have to start considering how scalable your strategy is, because the more scalable it is, the more investable it will be, and that's why it's part of the Darwinia investability assessment. So how do we assess scalability? Well, by taking into account the three components that impact investor slippage, the first of them being your trading style, meaning how often you trade, for how long you hang on to your trades, and in what assets you place your trades. Of course, market conditions also matter. So it's one thing to place one trade in news trading. Another thing is to place it when there are less volatile environments and more liquidity. And all these two combined, which are 100% under your control, will determine the assets under management that your strategy can scale with investors' money too. So scalability is assessed at Darwinia by looking at the probability that slippage even occurs, how likely is a strategy to get slipped, and combining it with the impact of slippage happening given that it has happened. A scalable strategy has low sensitivity to slippage, which is unlikely to occur in the first place. So, to the two elements, we'll first cover the probability of investor slippage happening. That depends on three subcomponents, one of them being the volatility of the assets you trade, the liquidity of your assets that you trade, and also the frequency of your trades and whether or not you choose to execute in fraction trades. Before I take away the conclusion, let me just say that news trading on illiquid assets will not scale as well as swing trades in the euro-dollar taken 1 month at a time. This is not to say that one strategy or another strategy is better, but it is true that one will be more scalable. So let's look at how asset volatility and liquidity are assessed in the Darwinia terminal. To look at it, you would go into the Darwinia part of Darwinex, check the scalability investable attribute, and go to the volatility and liquidity per trade chart. On the left-hand side, we can see the volatility chart in which we have broken down volatility episodes by percentiles, and we are plotting them here in different cumulative percentiles. On the left-hand side, we have the 5%, then the next 20%, and so on, ordered by volatility. So to interpret the chart, you should see, for instance, this particular strategy chooses to place 17.46% in the 5% less volatile elements of the market, which would speak for high scalability. And for instance, it also places a significant amount of its trades in very high volatility environments. All other things being equal, a strategy will be more scalable the higher the right-hand side of the two columns is towards the left-hand side of the chart. So let's move on to the liquidity per trade. So again, we do a very detailed tick level analysis of the market depth feed and break down the trading episodes into very high liquidity, in which this strategy places 2.4% of its trades, high liquidity, and so on. other things being equal, the more green you see in this pie chart, the more scalable the strategy will be. Another element which we have alluded to is frequency and trade fractioning. So we track it in the chart that I'll show you in a second. What we do is we say how much investor volume would be triggered for each of your trades if 1 million of investor volumes was invested in your 8% value at risk Darwin, because we have to normalize given a value at risk for this particular chart. Now, what we track here is the trade size that this 1 million of assets under management would have triggered. In this particular case, 5 million, for instance. So let's think that you're sending a trade for 40 million in the euro dollar to the market. What will happen there is that you will very likely wipe out the entire liquidity in the market at that point, and investors will get very slipped. One thing you can do to improve that is to fraction the execution of your trades by breaking them down into smaller chunks. So instead of sending one trade for 100% of your intended trade size, you can send one mini trade for a quarter of it, another one with another quarter, and so on, until you fill your desired risk level. And that will allow the liquidity providers in the meantime to replenish the liquidity so that you minimize the impact of slippage. It is true that you will introduce an additional element of slippage owing to the time delays between the different trades, but the benefit in that is that those time delays will introduce random slippage, which could work for or against you, whereas sending the 40 million trade will move the market only against your investors. So given a value at risk, the more volume per trade, the likelier your slippage. If you want to see this chart for yourself in the Darwinian interface, you would go into the investor volumes per trade and have a look at the chart and see the volume for each individual trade together with the cumulative volume triggered by the strategy. So basically you want to see as low as possible bars here for the strategy to be very scalable. To take away my conclusions, I have shown you a pretty scalable strategy because so far it is relatively unlikely to hit into slippage problems, particularly because the average trade sizes are so low. But we haven't covered yet the impact of slippage, and that's what we do in this other chart. So what is going on here is we are comparing the return by the original strategy on the top hand side, in this particular case making a 21% return, against the return by hypothetical slipped strategies by investors being slipped by 0.2, 0.5, 1 and 2 pips. And this particular case, you see that slippage has a big impact in this particular strategy because the original one makes 21%, whilst the investors slip by only 1 pip, which is not much, are already losing 5%. There are strategies that are less impacted by it. For instance, this one is making 9.6%, whereas the investor slipped by 2 pips is only lagging by 5% roundabout by making 4.5%. So the lower the average trade level P&L, the more sensitive your strategy will be to slippage, which is another way of saying you're making 6 pips on average. If the investors are getting slipped by 2 pips on the way in and 2 pips on the way out, they're only making 2 pips, and after a while there's not enough profit for the investors to still benefit. So to summarize, what helps scalability? Obviously, trading liquid assets at high liquidity times and low volatility, fractioning your execution to the extent that you can, and targeting higher average win per trades than you currently do, if that's at all possible, because you will be less affected. What does not affect scalability is your risk level. It is completely irrelevant with what value at risk you choose to trade, because your investors will have their own value at risk by choosing the 4% or the 8% or the 16% Darwin based on your strategy. So do not change your risk level to improve your scalability, because that's neither here nor there. So next steps, we have talked about the Darwinia challenge. You may check how it works by following this link. We have also talked about value at risk, so you can read up or watch up on this one here. And we have also talked about the Darwin product that you would market to investors, and you can learn all about it by going to this video. If you have any questions or feedback, please send it to us. This is Juan at Darwinex. because that's the only way for us to improve and make you a better trader. Take care and happy trading. Bye bye.